All right, welcome everyone to a new week. Before we get stuck into what's coming up for this week, we just quickly have to take a step back and look at a few developments that took place on Friday, starting with some unexpected tariff news. I mean, just as markets thought that things were, moving in the right direction when it comes to tariffs, Friday we got a couple of surprises. The first one was a tweet from President Trump warning Apple, the company, of a possible 25% tariff if the company doesn't move production to the United States. Now, on the back of that, risk sentiment took a bit of a tumble. We saw the technology sector being the worst performer on the day. No surprise there, down 1%. And Apple finished the session in the red, deep in the red, down 3% and total down 7.5% for the week so far. Now, after that, we also had additional negative news where President Trump tweeted that their negotiations with the European Union weren't going well, and as a result, they will be slapping 50% tariffs on EU goods starting from the 1st of June. Now, if we quickly take a look at chart performance here, we saw some pretty typical behavior as you would expect. Equity futures tumbled across the board, not just focused on European bourses, but obviously the likes of the DAX. The likes of the Euro Stoxx 50 was the hardest hit, but all equities pushed down. We had those high beta currencies, which is very sensitive to risk, like the Aussie and the Kiwi push lower. Obviously, the Euro pushed lower. We saw commodities also pushing lower, energy, base metals, even silver, and obviously yields took a bit of a tumble as well. Now, most of these moves were pretty well contained, despite the negative news that we had. And I think the reason for that is because markets are viewing this as possibly yet another negotiation tactic that could just be walked back once a deal is agreed, or once a pause is agreed, or some sort of concession is made, and whether the tariffs, gets added in the first place. Remember, Trump has walked back these types of numbers and threats so many times, it's very difficult for the markets to trust what he has to say. Which makes it very difficult for the markets to manage risk in these scenarios. It's a complete nightmare because you just don't know which way it will go. Now, the one interesting mover, though, and I think this is one of the key market moves that we saw last week, was the US dollar. Despite the negative news against the euro, the dollar just couldn't find any love. I think the risks of this obviously means that further tariffs just further isolates the US. And it further increases concerns about US policy and what all of this will mean at the end of the day for US businesses and US consumers. With all of that said, if you take a look at the amount of downside that we've had in the dollar so far, it's clear from last week's price action that dollar downside remains the market's favorite. And I had this one wrong last week. I thought that the dollar's downside was running out of a little bit of steam, especially when we look at things like positioning data, which is still showing, a very stretched US dollar short position right now. That made me cautious. I thought that there was a higher likelihood that the dollar sees a little bit of a bounce going into next week, but the markets felt differently. It's continued to add, shorts, press those shorts in the short term. Personally, I'm more cautious, right? I see no attractive risk to reward for chasing the US dollar lower right now. I understand the macro fundamentals, which is forcing the markets into this negative view against the US dollar, but it feels like a lot of those negatives, at least in my opinion, is already reflected in the price. So I'm very, very cautious of wanting to chase this move to the downside. But that is obviously one of the key themes still in play last week. The other one that we saw on Friday, which was one of the main reasons why we had a pretty solid recovery in the likes of the Aussie and the Kiwi, despite the negative tariff news, was the big move we saw in copper. Take a look in this chart, looking at commodity performance. You can just see this orange line, copper, just jolting to the upside. Look at this pop we had higher in copper. Now, the main driver for this, despite the obviously negative tariff news, this was all supply driven because there was some potential issues in the Congo with possible suspension of mining activity at the Kakula mine. Now, for those of you who don't know, Congo is a huge copper exporter. And when that news hit the wires of a possible disruption in supply, it just sent prices jolting higher. Now, what was interesting is there's actually a co-owner of that mine called Ivanhoe. We actually pushed back on the initial news of the disruptions, but we didn't really see that affecting the copper price. So any further news about production at that mine could be a possible driver in the week ahead for copper. And obviously, given the strong correlation that we normally have between things like the Aussie and copper, if you take a look at this chart, This shows you Aussie dollar index in blue, and it shows you copper in orange. Normally fairly close positive correlation between these two. So if we do get further news affecting copper, that is something definitely worth keeping on the radar for the Aussie dollar. Now, the other thing we need to quickly touch on is yields. Even though yields had a basically mostly flat week last week, the bond market, as always, and especially now, is very important for us to watch. Debt growth in the United States has or is expected to far outpace economic growth, right? And that is putting the US attractiveness as an investment destination. It's bringing it into question, right? Especially for longer term bonds, which has been at risk. Remember that the reason why this is so important, when you look at something like US 10-year Treasury yields, the 10-year is considered as the risk-free rate. It's the basis we use for evaluating risk and value across financial markets, right? It affects the cost of capital, it affects risk premiums, it affects risk appetite. It's used as the discount rate, for Pete's sake, in valuation models. So when yields go up massively, it means that there's a higher discount rate, and that means there's a lower present value for assets or cash flows. And when yields goes down, it's the opposite. That means a lower discount rate, there's a higher present value. Remember, this is something that's very important for the market right now, because if it wasn't for that big move that we had higher in yields, lower in bonds, that was the main thing that spooked the Trump administration into doing the 90-day tariff pause a few weeks in the first place. So watching what bonds do from here is very, very important. And because there's been a lot of question marks about how attractive US bonds are right now, that means that the auctions we've got coming up over the next few weeks could get more attention, because the markets, if we were to see really bad demand for bonds, that could send treasuries even lower, yields even higher, and vice versa. If the auctions comes out and it still shows solid demand, despite the deficit concerns, that should be a positive for treasuries and a negative for yields, all else equals, obviously. But this remains a key one to keep on the radar, guys. If we do move into an environment where bonds continue to fall and fall hard, and yields start breaking out to these recent highs that we had over the last 2 years, that's something that especially the likes of equities won't be able to ignore for a very long time. What will happen is, if we do get into an environment where we break to new highs, pushing yields even high, if yields goes higher fast enough, eventually it'll break the equity market. And eventually, if the pain in the equity market and the bond market hits rock bottom, then eventually you'll see government stepping in, you'll see the Federal Reserve stepping in, and usually that is when you see a clearer low or bottom for bonds and equities. But what that means, and because we're basically just stuck in this range for US 10-year yields, until we get to these high levels, there could be some pain that needs to happen first until we get that type of level of support. Bottom line is, bonds and yields will be a key one for us to just keep on the radar, and that makes auctions coming up this week a little bit more interesting. The other one that I quickly just wanted to touch on from last week is gold. One that got a lot of attention last week. We bounced from that key level of support, pushing up towards that 3,358 level going into the close on Friday. Now, I'm happy with the way that my two previous shorts for this one played out, and where I decided to get out, because that it seems to have been the bottom, at least in the short term. The question now is, do I want to join in on this move to the upside? Do I want to join the bandwagon of the bulls? Not yet. I get the appeal of reloading on Longshare, but one of the things that got me cautious, not the only thing, guys, but the one thing, a key one that got me cautious with that previous rip to the upside, the main reason why I leaned into that and shorted gold, one of the key reasons was because that move to the upside in gold wasn't backed up by ETF flows. And that's the exact same thing that we're seeing at the moment. If I just quickly go to this chart overlays your ETF fund flows in blue, and we've got spot price in white. And you can see that initial pop we had to the upside, the one that we sold into, that coincided with a continued push to the downside in ETF flows. Now, even this recent rip we've had in gold, it hasn't been supported by fund flows moving back in and scooping up these lows. So this isn't enough for me to want to short gold here again, because one of the key differentiators between now and the last time I shorted it is implied volatility is very low. Last time we shorted this, implied vol pushed lower, but we still had some room to run lower. Now we're even lower on implied vols, which makes a short far less attractive. But the bottom line is, as long as ETF flows doesn't start picking up and moving higher, I would be very hesitant on joining the bandwagon on the long side. So that's just something important to keep in mind. So what about the week ahead? In terms of the week ahead, we've got a couple of bank holidays just to take note of today, or at least tomorrow. We've got UK bank holiday as well as a US bank holiday. What does that mean? It means thinner trading conditions, low liquidity, low volumes. So always just be careful of price action around those types of days. And furthermore, late in the week, we also have on Thursday bank holiday for Switzerland, for France, and for Germany. Again, watching liquidity and volumes will be important on those days. The other thing we obviously need to watch is tariff developments. You know, any further escalations like the EU slapping the retaliatory tariffs on the US, or the US increasing the 50% number, or a deal being reached, or concessions, whatever. It's going to be important for us to watch that for the markets. Massive escalations in that tension could see further downside for US equities, European equities, as well as the dollar and the euro. If we get some good news, it could provide some reprieve across the board. So keep that in mind. Apart from that, the one thing that you won't see on the calendar, but obviously that we need to take note of, is that we have month end coming up this week. Now, why that is important, it's worth noting that you have two types of month end triggers we need to watch. 2 days before the last business day, the 2 days before the last business day, as long as that 2 days is also a business day, is called corporate month end, right? And the official last business day of the month is official month end. Now, why this is important is month end and corporate month end can have some pretty punchy flows that comes into play from time to time. We have corporate month end taking place on Wednesday, which is T-2, and official month end on Friday. Now, as usual, we shouldn't be surprised around those days if we see some very erratic moves in the US dollar, both up and down, because month-end flows can sometimes trigger some very punchy moves, especially when you get close to the 4 p.m. UK London fixed time. Now, as a general explanation, market participants usually expect some dollar appreciation going into corporate month-end, which is Wednesday, and some depreciation in the dollar into official month-end, which is Friday. But in my experience, guys, the hit rate with trying to trade those types of views are not great. So the bottom line is just be aware of the possibility of seeing very erratic price behavior on Wednesday and Thursday, Wednesday and Friday in the US dollar, which will be just purely based on market flows. Now, in terms of other risk events we need to watch, we've got a couple of ones coming up. Nothing crazy exciting though. The first one we'll be watching on Tuesday will be Aussie CPI data. This one could be interesting. I mean, a miss in the data will be by far the simplest way to trade and look for opportunities. The reason for that is because we had the RBA surprising the markets on the dovish side last week. They were a lot more dovish than what I had anticipated. I was expecting the bank to take more of a hawkish cut last week, but they came in pretty dovish. They downgraded growth by more than expected. They said that their previous fears about inflation didn't materialize, and they even said that they were discussing a 50 basis point cut, which is crazy. At the meeting, obviously decided to go only for a 25. Now, the markets. This saw the markets basically upping their expectations for cuts from the RBA. The markets are now pricing in very close to 3 more cuts by the end of the year. So obviously, if we were to get a very big miss in Aussie CPI data on Tuesday, that'll be the simplest way to express that, by just further pressing on some Aussie dollar shorts. Obviously, we need to watch copper. Like I said, if copper rips higher, even if CPI comes in lower, that could still provide some support for the Aussie if copper is pushing up. If copper pushes lower though, and we were to see inflation surprising to the downside, that's arguably the most simplest way to express the Aussie would be with a miss in CPI trading in line with the market's view of more cuts from the bank. Also on Tuesday, we have the RBNZ policy decision coming up. Now, the bank is expected to deliver their 6 consecutive rate cut this cycle, taking the cash rate down to 3.25%. Now, the markets, if you take a look at this, the markets are fully pricing in that 25 basis point cut. 22 out of 23 economists surveyed by Bloomberg agree that, yes, we are expecting another cut. The real reaction because of this will not be on the cut itself, because that is fully priced in. The main focus point will be on the forward guidance. Now, why are the markets so sure we'll be getting a cut? Firstly, domestic inflation is cooling, and expectations for inflation has been well anchored. CPI is expected to basically remain within the target, even if headline inflation has a little bit of a temporary bump due to oil prices. We also have the labor market that has softened. Job vacancies are down, wage growth has eased. We also saw net immigration recently falling, so that's obviously a negative as well. We also have trade risks, right, which is the big elephant in the room. Even though the threat of like an outright global trade war has cooled a little bit, Friday's threats against the European Union rather, is just once again a reminder that those things haven't eased back, and that's something that the bank will definitely be focused on. Now, even though all of this supports the idea of a cut for this week, there is a question mark on what this means for the medium term. Remember, the bank has already cut 5 times. This week, they're expected to cut the 6th time, the consecutive cut in a row. And in February, if you take a look at the bank's projections, their own expectations for where they see the cash rate going, the bank only projected the cash rate to fall to 3.1% back in February. Right? Now, if we were to get that cut this week, that basically puts us at that 3.2, 3.1 level, which means that if nothing has changed in terms of the RBNZ's assessment from February, then that does leave some room for a possible hawkish surprise here from the bank, even if they cut rates, right? Because the reason for that is the markets, just like the RBA, the markets are almost fully pricing in another 3 cuts for the RBNZ, including the one from this week. So 2 more after the one that they were expecting this week. Which means that if the bank should come out, and even if they cut rates, but they say, hey, we are probably done now, we're not going to look to cut rates again, and they stick to their previous February view of no more cuts after this one, then obviously that can create some upside potential for the likes of the Kiwi. The way that I'll be expressing that personally is by just adding to some of those Aussie Kiwi shorts that I got into last week following the RBA policy decision. So that's the way that I'll be positioning for that personally. And that's the way that I'll be looking to express that view if indeed we get something like that. Now, apart from that, we also have some US data this week. We've got US GDP. This isn't one that we normally watch because this is the second estimate of Q1 GDP. But coming into this sprint, there are a couple of market participants going through a few week ahead reports. There is a couple of participants that think forecasters might not be looking at inventories correctly in their assessment for this print. And that as a result, they think there could be some upside risks for the Q1 GDP number. Now, of course, given how stretched the US dollar is to the downside right now, if we were to get much better than expected data coming out of growth, that could ease some of those high debt, low growth concerns, and that could provide some lift for the US dollar in the short term. However, the risk here is that because this is Q1 data, and so much has happened on the tariff front that maybe the markets just completely ignores this data. That is what I'm expecting from Friday's PCE data out of the US as well. Even though this is the Fed's preferred measure of inflation, I'm not expecting this to be a big trigger, to be honest. I think the market should be able to read through or look through these data points fairly quickly. The one thing that we do need to watch this week, though, will be all of the bond auctions coming up from the US. We've got the 2-year note coming up, the 3-year note coming up. We've got the 5-year notes. I believe we've got the 7 as well. 7-year notes, there we go. All of these bond auctions will be important for the reason that I explained earlier with the bond market. If we were to see the bid to cover ratio for these auctions drop massively, showing a big lack of demand, obviously that'll be bad for bonds, bad for the dollar. If, however, demand shows up very solid, lots of buyers, strong, solid demand, that could be good for bonds in the short term and good for the US dollar. So that is definitely one to watch. Now, the other thing that's coming up this week on the equity side specifically, let me just quickly bring this up for us, is earnings season continues. And the big name that everybody, of course, will be watching this week will, of course, be NVIDIA. That is coming up Wednesday after the close. The reason why this one is important, obviously from an AI theme point of view, that name will always be important for us to watch, but more so, NVIDIA's got a 6% weighting in the S&P and an 11% weighting in the NASDAQ. So any major surprises there with earnings is something that can impact the markets as well. So with that said, that is everything for the week ahead. Those are the main charts and considerations we are looking at. If there's any questions, as always, don't hesitate to let me know. But with that said, hope everybody will have a fantastic week ahead.